Dean Maki, chief economist at Barclays Capital. He's also a Bloomberg best. Dean, welcome back to In Business. Does in any way this sense of panic that we're seeing reflected in the markets about a potential downgrade 2 years from now, at least an outlook downgrade in the immediate term, does it in fact move the conversation forward? Does it heighten the chances for some sort of consensus to be reached?
I think we'll just have to see how the political leadership reacts to this. I mean, what the S&P change is highlighting is that we do have a medium-term fiscal budget problem in the U.S. that will need to be addressed through policy changes. Now, whether that gets addressed or not is really the question, and I think we'll just have to see how this political debate transpires in the next few months.
So 1 in 3 chance, S&P says, that the long-term rating will be lowered within 2 years. You agree with that?
We don't really put that kind of probability on it. It's not something in the economics group that we try to forecast these rating changes. But I think that there is a significant budget issue, and I think whether it gets addressed or not is a significant risk to the outlook when we're talking about a medium-term context.
Well, the reason that we're so hyper-focused on that is obviously what this would mean in terms of impacting the broader economy. You've recently raised concern that in the near term, you do think growth is getting eaten into by higher costs for consumers.
That's right. The food and energy price surge in the first quarter, we think, is one of the factors that caused GDP growth to slow, in our view, to about a 2% annualized pace, weather being the other factor. We do think that rate of headline inflation on a quarterly basis is going to come down a bit in the second quarter, though, and that should allow real spending to reaccelerate. So that's what's in our projections. We do think that consumer spending is holding up well in nominal terms. If that rate of inflation comes down even just a bit, that allows real spending to reaccelerate.
What's a bit to you, and what are you looking at as having the biggest impact? Is it gas prices or is it the cost of food?
They're both having a significant impact. Gasoline is having a bigger impact, but food costs are accelerating quite notably as well.
You also think that somehow the weather patterns are impacting the growth that we're seeing now. I mean, how are we in some way, pushing growth off to the future? Because you are seeing this bounce back.
That's right. So in the construction sector, especially in the non-residential construction, we saw much more weakness in Q1 than the fundamentals would suggest should have been there. And we think, given what we saw in the employment report in January, given what we saw in the construction numbers, there probably was a significant weather effect. And we think there should be some normalization in the second quarter, which should give a boost to GDP growth.
Dean, Austin Goolsbee, the White House, basically chief economist, was just on this show, and he says, you look at the bond markets right now, and Treasury rates are below historical levels. There isn't a sense of panic. There seems to be certainty, he says, that the debt ceiling will be raised. Does he have the correct read of what's happening on Wall Street?
Well, certainly prior to this morning, the markets were in a pretty benign state in terms of the Treasury yields. There isn't a lot of worries priced into the level of yields we're seeing right now. Now, we have seen some backup this morning in yields, but I think even when we step back afterwards, the market is giving a pretty benign interpretation of the likely outcomes here. The yields could move quite a bit higher if markets really did start to worry.
Mm-hmm. But today you see is sort of just the first reverberations of that. You're not forecasting or expecting real panic as we get closer to that May surpassing of the debt ceiling, according to Treasury Secretary Geithner.
Well, we think it really depends on how the debt ceiling negotiations play out. We think if the debt ceiling is not raised and we get into this period of significant uncertainty, then yields could move a fair amount higher. We could see a steepening of the yield curve.
Overnight, once again, we saw China, signal some inhibitions about the rate of growth and the rate of perhaps overheating that they're seeing in their own economy. Put in perspective for me how this global economy and how that might feed back here in the United States. I mean, are you getting increasingly concerned?
Well, one of the things that we think is really driving inflationary pressures and growth globally is very easy policy stance on a global basis. And one of the things that's happening here is that many central banks think of commodity prices, food and energy prices as something that's determined globally and therefore not something they need to address. So we think systematically global policy rates are being held too easy. That is one of the contributors to higher inflation.
So is it transitory or not?
We don't think so. We think that there is going to continue to be upward pressure on many commodity prices as long as the policy stance stays as easy as it is. We are forecasting modest tightening by many central banks this year, but this easy policy stance basically is going to remain in place.
All right. Dean Maki joining us this morning from Barclays Capital. Thank you very much.